Welcome to another edition of the Trading Bell. We're coming to you from the trading floor at the Nairobi Securities Exchange. Today on the show, we'll be talking about the property market and some of the interesting developments we continue to see in the industry. And I'll be hosting the Chief Executive Officer for Stanley Fahari REIT, and that is Kenneth Masika. So really, who is Ken Masika? Kenneth has over 18 years' experience in the property industry, most of which he gained as a partner at Lloyd Masika Limited. He holds a Bachelor of Science degree in Land Management from the University of Reading in the United Kingdom. Kenneth's specialities include urban property valuations, both in Kenya and in the East African region. He is also well-versed in property management and estate agency services. Join me now for that conversation. Many thanks, Mr. Ken Masika, for joining us.
Thank you.
Pleasure
to be here.
All right. Well, let's just begin off having been in the property market for a number of years. Of course, the concept around real estate investment trust continues to be a concept that many Kenyans are yet to embrace and fully understand. Let's just begin by you telling us really what are REITs and how can people tap into this kind of investments?
Thank you, Abby. A pleasure to be here. I'll start by giving you a definition of a REIT. A REIT can be defined as a regulated investment vehicle that allows people to come together collectively to invest money or money's worth as consideration in a trust, which is then divided into units, which each person gets an allocation. When they get the allocation of units,
yes,
they then benefit from the income from the property that the REIT acquires. REITs are regulated in Kenya by the Capital Markets Authority after the coming through of the REIT regulations in 2013. And there are basically three types of REITs that are allowed by the regulation. There's an income REIT, which invests in income-generating assets. There's a development REIT for development purposes, and there's a Sharia-compliant REIT.
All right.
And how Kenyans can invest into it, obviously REITs can be listed like Fahari is, and the listing allows Kenyans to come in and out as they choose through their stockbroker, just like they would trade any other listed security.
All right. Quite clear now.
Thank you.
And moving on to the second issue, of course, recently you did record a 6.5% return following your listing. How would you describe this? Is this a measure of the vote of confidence in the markets?
I believe it is. What has happened, obviously, in the last 2 years that we've been listed, we've actually spent quite a bit of time in engaging in investor education and awareness, and we believe that investors are now starting to get on board with the message and are looking at a REIT as a long-term investment.
And Masika, looking at the property market, it's been one of the best performing asset classes, and of course there are debates around it as well that we might be having a property bubble. But from where you sit, would you say that property has been delivering solid returns? And if you could also respond to the issue around the property bubble.
Okay. I believe if you look at property as an asset class over the last 10 years and the previous period, property has always outperformed virtually every other asset class. I do not believe there's a property bubble. I think the issue is people need to look at property as not a homogeneous. It's not a homogeneous product. In other words, you need to look at specific types of properties, location, and the demand for them. I think when a lot of people say there is a bubble, it is normally where there's an oversupply of a particular type of a property in a neighborhood. Then obviously when you've got more supply than demand, you will have an impact on pricing and uptake of the same. But I do not believe there is a bubble in the economy, in the property sector.
And still linked to this, Masika, of course, when we look at the appreciation of property, it's been skyrocketing. We're seeing various properties hitting over 100% per year return in terms of how fast it's been able to appreciate. Do you feel the fundamentals are right that is behind the high property appreciation we are seeing?
Okay. I believe the fundamentals are right. One, again, has to look at the specific attributes for the specific asset or property that you're looking at. In areas that are rapidly growing, you'll find it is normally where the government has has undertaken sort of major projects like infrastructure, made it more accessible. Like if you look at our shopping mall in Greenspan, Donholm happens to be one of the areas with the largest or highest property rise in prices, and that can also be attributed to by the new outer ring road that is just about to be finished.
Yes.
In areas where the market has sort of matured, you will not get as significant jumps, but there is obviously a year-to-year growth in properties.
And just a follow-up question to that. Of course, when we're seeing this kind of high property appreciation, where does this leave the speculators?
In terms of speculation, you always have to be careful as to where you're putting your bet. Given the fact, like I'm saying, in certain areas, there's always new developments coming on board for each particular sector. So if you're a speculator, you need to be able to read the market and know when to come in and when to exit. I think the government is also putting in a fair bit of pressure and changes in regulation to really stifle the speculator aspect of things. It is a business. At the end of the day, we are a capitalist society, so we are in it to make money. I just believe that rather than speculating, if you put an asset to what the regulations allow you to do, the user. If you buy a property that's commercial, develop a commercial building, you'll find your returns tend to be much better than just purely being a speculator.
All right. Speaking about returns, your company recently posted a 61% rise in earnings for the year under review. Perhaps what would you attribute this to?
In terms of the rise in earnings, and obviously one of the things to take into account, it was a difficult year. I think everybody felt it throughout the long electioneering period. The REIT was not exempted from the impacts of that, but one of the things we did as management was we actively managed our properties. So the growth came about from a 12% rise in rental income, which is our main source of income from the REIT. We do invest some bit of money in fixed deposits and treasury bills. We managed to achieve 8.5% for our fixed deposit on average and about 10.5%. So that contributed to that. The other major contributing factor was that this year we had a big reduction in fund management costs. As you're aware, last year in 2016, we had one-off listing costs for marketing and the like that were not recurrent this year. And finally, as we have been investing the properties, as the properties are vested and we've actively managed them, we have looked at reducing and really managing the cost at a property level to ensure that we are getting value and quality for the services that we engage with service providers.
And Masika, it seems cost containment was one of the big strategies that you employed in terms of ensuring you manage your costs. But aside from this, moving forward, how do you align the company towards warding off competition, because we're seeing a lot of interests coming in the property sector, a number of investors looking forward to, of course, table to the market various kinds of instruments. What will be your competitive edge moving forward?
Our competitive edge obviously will be firstly in the product itself. Like I said earlier, it's regulated, and under that regulation, we are required by law every year to pay out at least 80% of our net income. Now, you'll find with a lot of other investment instruments, there is no that requirement. And even if there's that requirement, you do not have such a high ratio for payout. So we offer the advantage that we are able to pay out fairly high returns. Secondly, the REIT is one of the few investments that is tax exempt. REITs are exempt from corporation tax under the Income Tax Act, Section 20, and that is a big advantage. It basically outweighs any other sort of property holding structure that you would have. So that gives us an advantage on that basis. And finally, as management, we look to sweat our assets as much as possible to grow returns. At the end of the day, any investor and any competition coming in, they're looking at returns. It's always a yield game.
All right. And of course, you've mentioned a very important point that you'll be sweating your assets in this year. Of course, the other big question is around what is in the pipeline in terms of new acquisitions. There was talk of you acquiring some office property valued at just under, actually, 850 million, if I'm not wrong. How will this play out for your case, and how do you look towards raising the capital?
That's correct, Abby. One of the things we've been looking at are the REIT. In our initial seed properties, we had Greenspan and 2 other smaller assets. We found that our property portfolio was basically in retail and light industrial come office. One of the things we've been looking at is playing in the large 4 sectors, basically light industrial, residential, hospitality, and offices. We are leaving out residential for the pure fact that their leases tend to be annual, and we'd like a long lease that is stable in growth. So with our first 3 assets, you find that Greenspan Mall accounts for 88% of the property portfolio, and that being in retail. As you're aware, last year was a very challenging year for retail.
Yeah.
We were lucky or fortunate to weather it. We had an anchor tenant who did not have issues like most of the other landlords in large retail malls had. So what we've tried to do is now introduce some diversification, because we believe diversification is the key to managing your risk. As you see from the initial portfolio, there is a concentration risk in retail.
Yes.
So consequently, what we've done, we've gone out identifying properties in a pipeline, with one of the main aims being, obviously, returns, as I stipulated, are key, but the second issue is diversification. So we did identify a grade A office building located in the Lavington area for 850. It meets the current funds returns. We are averaging 7.5% on the current fund.
Yes.
The inclusion of this property will add, or this property specific return is 8.35%, which is definitely an accretive return to the fund. And then it enables us to play in a different sector. So by now adding it on, you find that the dominance of Greenspan is reduced somewhat. So now we'll have a property ratio of about 66% in retail, 26 in grade A office buildings, and the other 2 will drop down to around 9%.
All right. And I'm looking forward to this, actually.
Thank you.
And finally, Masika, of course, there are risks in the market. And of course, we do know that property is very sensitive to the political environment and, of course, the policy issues around land. From where you sit, what are some of the biggest challenges right now when it comes to tapping into new frontiers for your business, as well as growing the returns for the shareholders that play a part in your investment options?
Absolutely, like you're rightly saying, politics has been a big issue. You know that every time we go into an election cycle, things tend to cool off, property prices tend to stagnate, and it's largely based on the Kenyan feeling of sort of let's wait and see. And they tend to apply that from your sort of retail spending as to whether you'll buy a couple of new suits through to a large investment. So that sort of cooling off obviously has an impact down the line in terms of outcome and what people do spend in sectors like retail. So we are glad that political temperatures are cooling. We'd like to see them cool further so that we can go back to business as normal. There are a few laws that are under review. I must commend the government that they are making strides into sort of streamlining the property sector. One of the biggest issues for funds like ourselves has always been an issue of sanctity of title. I'm sure you've had the horror stories where people invest in property only for 2 or 3 years, the title to turn out to be a duplicate title and the like. So we've seen the government at least try and streamline the registries, computerize them, make it a lot more difficult for people to fiddle with some of those documents. But we believe one of the ways to ensure that you get a proper return is to have a well-diversified portfolio. Invest in the right asset, in the right neighborhood, in the right sector. That way you will always weather some of these storms and manage it properly.
Quite interesting. Many thanks, Ken Masika.
Thank you.
Appreciate your time.
Thank you.
Well, we've been speaking there to Kenneth Masika, who is the Chief Executive Officer for Stanley Fahari, just walking us through some of the